The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Tech stocks getting some of their mojo back, and so too does the broader market. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the United States. Some mojo, but only some. The S&P 500 higher by about 0.3%. That certainly is higher than where we finished the day up yesterday. But consider that we were nearly 1% higher a little bit earlier in the session. So a little bit of an enthusiasm drain here. Big tech, though, as Romaine mentioned, leading the way. The NASDAQ 100 higher by about 0.5%. You do have a little bit of a sell-off when it comes to the bond market. I threw up the 2-year yield here. You can see it's higher by about 2 basis points. We got those Fed minutes about an hour ago, and it was a little bit more hawkish than maybe some were expecting. We'll get into that as well. And Bitcoin, the slide continues, Romaine. Bitcoin currently down about 2%. We're back at $66,000 a coin.
All right, we're going to get back to exactly why we're seeing a little bit of weakness in stocks coming off the highs of the day. But coming in today, remember, a major drag on the S&P for the past month had been the absence of any meaningful moves higher in those highest weighted names in the index. Big tech stocks that weren't really acting so big as investors grew a lot more skeptical of that near $1 trillion AI build out and the nearly unprecedented market valuations that had arisen as a result. But after a 2-week sell-off in the Mag 7 and an even more brutal 3-week sell-off in software stocks, there are a lot of concerns right now that the valuation drop actually brought out the dip buyers. Retail traders, apparently they spent a record amount over the last few days snapping up software shares, at least based on Citadel Securities' platform. The firm saying that the magnitude, the persistence, and the breadth of that buying was materially exceeding prior peaks, underscoring retail's role as a primary source of incremental demand here at the start of 2026. Now, also aiding in that positive sentiment today were economic data points this morning showing U.S. industrial production climbing in January by the most in almost a year. Orders for business equipment rising more than projected in December. Housing starts hitting a 5-month high, and an encouraging prelude out there right now to Friday's GDP report, which will give the most comprehensive first look at how strong economic activity was in the fourth quarter. Economists projecting annualized growth for 2025. The full year came in at a respectable 2.7%. But Katie, that's what happened in the rearview mirror. I think people are starting to look forward.
Absolutely. And let's take a little bit more time and look at the rearview mirror, though, because those Fed minutes that we got about an hour ago, as I mentioned, perhaps suggesting that maybe a rate hike scenario, at least that conversation should enter into the ether. And with that in mind, I thought we'd take a look at this chart. It's really interesting. In blue here, this is the Bloomberg Economics Federal Reserve Sentiment Natural Language Processing Model. Stay with me here. It's interesting. It usually tends to track the 2-year Treasury yield. That's what's in blue here. But take a look at that side of the chart. You can see this divergence has started to emerge. It started towards the end of 2025, as you can see in December, and it's only grown as we get deeper into 2026. It'll be interesting to see when these two lines come back together and in what direction, Romaine, because at least right now, the consensus on the street is that we're not going to get rate hikes. This is still a rate cutting conversation, but still maybe the debate should be had. Well, that debate is now maybe intensifying. We should point out the S&P 500 peaked around 1 p.m. Eastern time. At about 2 p.m., it took another leg down after the release of the Fed minutes from the most recent meeting. And what was the read? The idea that maybe potentially worries over inflation are now taking more of a front seat than some of the worries about the job market. Here with more context on those Fed minutes is Jurrien, Director of Global Macro for Fidelity. And Jurrien, I do want to start there. I mean, for the last few months, last few quarters, really, it has been all about the Fed focus on potential softness in the labor market. Inflation wasn't so much of a concern, but those minutes seem to suggest, at least the debate behind closed doors, is that the inflation fight has not necessarily been won.
Yeah, I mean, I think that's a great observation. And remember, a few years ago when the Fed was at 5 3/8, it was well into restrictive territory. And now that inflation has come down to about 2.4, which is still above the Fed's target, but not by a lot. And the jobs market, of course, has been softer. The Fed has been recalibrating its policy towards some level of neutral, right? And so the Fed's long-term neutral is 2% inflation plus 1% R star, so that's 3%. And indeed, the Fed funds or the SOFR curve is suggesting that that's where we'll eventually go. But at 2.4% plus 1% R star, you're at 3.4. The Fed's at 3, and not very much above that. So the Fed is basically at neutral, and whether it goes another half a point or not, I don't think it's really that material. I mean, you could argue that the incoming chair, assuming that Mr. Warsh is the incoming chair, he might want to steepen the curve and deregulate the banks in order to, as they call it, privatize the Fed's balance sheet. But that might be something more for the second half of the year.
Well, this gets to the idea, too. I mean, overall, while stocks have gone through some issues, most of those issues seem to be less tied to macro conditions and the Fed and more tied to just some concerns about valuations in that AI trade. That sell-off that we had seen over the last few weeks was less a sell-off, more of a rotation into non-tech related names. And I am curious, Jurrien, as to whether you see the potential for that to continue, and if so, what is driving it?
Yes, so the Mag 7 peaked in October of last year. It's hard to believe, but it's already 4 months ago. And it has been sitting in a holding pattern now. And actually, just last week, it touched the bottom end of that range. But so far, despite that lackluster performance, the market has been able to broaden very nicely into other sectors while maintaining its relatively upward slope. I mean, the S&P hasn't really done much at all this year, but still, compared to the scenario where the Mag 7 drags down the index, even though the market's broadening, I think this is basically a win. About 2/3 to 70% of the stocks in the S&P are now in uptrends. The bull market is now in its 40th month, right? It started in October 2022. Typically in that fourth year, it does tend to kind of flatten out and get more rotational and a little bit more churny. And I think we're seeing all of those things. But again, as long as the Mag 7 do not go into a downturn, the market can broaden without going down. And I think compared to other scenarios, that's very positive.
Well, Jurrien, let's talk about what that means at the index level, because as you point out, I mean, we've kind of been treading water on the S&P 500 for several weeks here at this point. So assuming that we don't see a downtrend when it comes to the Magnificent Seven, we can continue to see this broadening out. But to truly break out on the upside, do you need big tech to cooperate and actually drift higher as well?
As long as big tech does not go down, the market can go up as it broadens. But I don't think we're going to see the kind of returns that we've seen, in the last few years. I mean, the S&P 500 cap-weighted index is up about 103% since the bull market began. The equal-weighted index is only up about 46%, I believe. So there's quite a gap there. The market really has over-earned, if you will, what it might typically have done. So I don't see a lot of upside, but again, after a very strong couple of years, even modest upside, I think, will keep us at very much above average rates of change going back into history.
Right. It's a good point that, perhaps we're looking a little bit spoiled after several years here of double-digit gains. So maybe you have to moderate your expectations when it comes to the S&P 500, for example. But what does this mean for other indexes? If you think about the equal weight index, for example, if you think about the Russell 2000, for example, are there better places to hang out at this point?
Yes. And for investors, that is a very positive development. So not only equal weight or down cap, mid cap, small cap, and actually since the April 2025 tariff tantrum, the S&P equal weighted index has almost completely caught up to the cap weighted index. It's about 34% gain versus 38% gain. But if we go overseas, we see that developed and emerging market equities have done extremely well after underperforming for over 10 years. And so for investors, as we face this concentration risk where 10 stocks in the S&P are 40% of the cap, it's important to have a broader menu from which to choose, or a bigger pond from which to fish, not to use too many metaphors. So I think that's a very good thing to see as the market has gotten more concentrated. For me, the only question is, does that broadening happen in an up tape or a down tape? And so far, it's been in a flat to up tape. Certainly across the ocean, we're seeing very good activity as the fundamentals there improve as well.
Jurrien, always a pleasure. Jurrien Timmer, Director of Global Macro for Fidelity, kicking us off to the close here on this Wednesday afternoon. We continue to focus on the economy here through the lens of middle market corporate banking, a deeper dive into the world of commercial banking and how enterprises are navigating the geopolitical and macroeconomic uncertainty. Wendy Stewart, President of Global Commercial Banking for Bank of America, joins us in a second.
Then we'll take a look at the broader financial markets as a whole, as well as the growing role of private assets with Hynes. She is the CEO of Wellington Management.
And from private assets to designer assets, an exclusive interview with the CEO of the Coach brand, Todd Kahn. He's going to talk about the secret sauce behind the resurgence of the 85-year-old company. All that and more coming up in just a bit. This is The Close on Bloomberg. Time now for our top calls. Big movers on the back of analyst recommendations. Let's kick it off with Palantir. Mizuho upgrading the data play to outperform and maintaining the 195 price target. The firm saying Palantir is, quote, in a category of one thanks to revenue growth and margin expansion. The shares, which are slumped as much as 27% to start the year, now on a 3-day 5% run. Next up, Dollar Tree, Rothschild Redburn upgrading to buy and more than doubling the price target to 165 from 75, saying that the company's Family Dollar divestment makes Dollar Tree a higher quality, higher return, more cash generative opportunity than it has been for the past decade. Those shares up for a second day. And finally, we got to take a look at Crocs. Williams Trading cutting its rating to sell, only one of 2 sell ratings on the stock. The analyst citing eroding demand for the once hot shoes, warning the company will likely and once again under-deliver on its full-year revenue and margin forecast for the year. He does, though, bump the price target to 84 from 75. Partly because of the potential for share buybacks. Crocs coming off its best weekly gain in about a year, sliding as much as 5% on the day, now only down about 2%. The man behind that call, well, he joins us right now. Sam Poser, Senior Equity Analyst of Footwear and Apparel at Williams Trading, joins us right now. All right, Sam, give me a sense here of what really ails this company, because it seemed like the last few earnings report, the sales growth wasn't awful, but what's happening that gives you sort of, I guess, a little bit of pause here that they're going to miss on some of their projections?
Well, first of all, the business is very back-end loaded. The guidance is very back-end loaded. And secondly, the wholesale demand in the U.S., and if you look at the wholesale currency-neutral numbers in their international business that came out of both the 3Q and the 4Q calls, was weak, which is, and then they're starting to open a lot of stores again. The store count back between like 2009 and 2013 went from about 300 to 600 doors. Then they started, as they reset the brands, they started to close stores. It dropped to 340. These are owned Crocs stores, and then it went up to 439. They have about 2,600 mono-branded stores globally, many of outside of the 439. The balance are owned or run by distributors and partners. So they said they were going to open about 200 to 250 stores this year, of which it's very unclear how many are going to be owned and how many are going to be partner doors.
Right.
And when they start opening stores, I believe that that's a sign that their competitive edge, isn't as good. And we've spoken to a lot of retailers here in the States, and it appears like almost everybody's planning Crocs down, and that doesn't seem to be showing any signs of light anytime soon.
Right. Well, that's what I wanted to ask you, Sam. Why them opening more stores, planning to expand their footprint here? Why that's necessarily a negative sign to you? I mean, what is the company hoping to achieve with these new stores? And again, why do you view that as potentially the wrong move to make?
Well, okay, so there's 2 different stores. There are the stores that they own and the stores that are partner stores. And most of the stores don't appear to be in the U.S., at least the partner stores. The problem is we don't know how many owned stores and how many partner stores there are. But when people, you want to get your brand out there more, and when your wholesale partners aren't buying your product because their demand is going down, you need to keep growing, so you open stores. We saw this, as I said, between like 2009 and 2013, and then they realized they had to just tighten things up, and get focused. So the store count stayed sort of level for a few years, and now they're starting to grow them again as the wholesale business erodes, which means we want to grow business, we need to grow, and since we're not going to get help from our wholesale accounts, we're going to do it ourselves, which if there's demand, then the wholesalers would want the product and they could open stores. But it looks like they're telling you that the wholesale business is weak. It's going to stay that way, and they're going to try to offset that weakness by opening stores. So we're seeing exactly the same thing with Hey Dude as well.
Right. All right, Sam, unfortunately, we're up against the clock. Have to leave it there. That is Sam Poser. He is Senior Equity Analyst of Footwear and Apparel over at Williams Trading. Now, coming up, a conversation with Wendy, Stewart, President of Global Commercial Banking for Bank of America, on her outlook on the health of that sector. That conversation up next. This is The Close. Well, top of mind for international investors in this current climate is how to position their portfolios given the geopolitical and macroeconomic uncertainty. Our next guest says that they are seeing international clients looking to establish a U.S. foothold as they navigate new challenges created by tariffs. Joining us live to discuss is Wendy Stewart. She is President of Global Commercial Banking for Bank of America. First off, Wendy, it's great to see you.
Thanks, Katie. Thank you for having me today.
So as I mentioned, Sell America has been the talk of the town when it comes to the investment community. But for the middle market companies that you work with, that you serve, it sounds like it's a much different conversation.
It is a different conversation. And in global commercial banking at Bank of America, we work with U.S. and Canadian-based companies. They're across a variety of sectors. And we also cover their U.S. or their international subsidiaries. And so what we're seeing is that our clients have gone from caution to confidence, and they are looking for growth. And that could be growth in the U.S., and it's definitely growth outside of the U.S. And then we also see companies that are based outside the U.S. wanting to invest in the U.S. So we see growth across the globe.
Well, let's talk about that switch from caution to confidence. I'm curious what the catalyst is. What has changed in the past few months, especially when you think about trade policy at this juncture? Is it just time sort of healing all wounds here, or was there a specific, event that you can point to?
I think despite the ongoing economic uncertainty, despite the political environment globally, that our clients are saying, you know what, we have to grow, and we've got to find ways that we are going to do that. And so they're really looking at three ways to get after those opportunities. The first is organic growth, and that could be in the United States. It could be outside of the U.S., and they're looking at all options. The second is growing through acquisition. And we have seen our M&A pipeline grow 30% year over year. It really started to pick up the second half of last year, actually, as our clients got more confident. And then the third is that global expansion. And so really picking and choosing where they're going to invest. And we see those opportunities across the board.
I am curious, though. Obviously, the geopolitical risk, the tariff issues, that still kind of lingers. And I am curious as to whether, at least for those folks that are borrowing money, is there a premium that effectively they might have to pay because some of these issues are still unresolved?
There really isn't, because when you think about we're in a really good credit cycle right now, actually, and credit availability is there for our clients. It is not a challenge, for them to access credit. And so I think when you have those type of economic trends, then they're going to take advantage of that and invest.
Yeah. What industries are most of your clients, and where's the largest cluster? Is it kind of on the industrial side, the tech side?
We cover everything.
Yeah.
So it's really what sector do we not cover, and there isn't one. So It's everything from the commercial and industrial sectors that you would think of, a lot of the emerging, what we call new economy sectors. So that's healthcare, it's technology, and then we have a professional sports and advisory practice. We cover commercial real estate, automotive dealers. We cover the economy. So we have a really good sense of what is happening across the U.S. economy. And what we are seeing is that clients want to grow.
And my understanding is middle market, the way that you're defining it, is annual revenues of up to $2 billion, correct?
Yes.
And it's interesting, taking a look at your notes, you point out that a lot of these businesses are actually family owned, that there's several generations into being family owned. And I wonder, how working with that client is different than, a more normal business that doesn't have that family connection.
It's a great segment that we cover. And so we call these companies family enterprises. And they're typically now third to fourth generation owned. And what's important about these clients, they generate 25% of the US GDP, and 30% of the workforce in the United States are employed by family enterprises. They're a big segment of the US economy. But what's a little different about these sectors, or these companies, versus, say, a private equity-owned company or a publicly traded company, is their long-term orientation. They think for the long term, they make decisions over the long term. And so they're very patient. And I'll give you an example. We have a middle market sized company, family enterprise based in the Midwest. And over the last couple of years, they were looking at, if you remember the reshoring, nearshoring, there was a lot of conversation about that. They were looking at what they had invested in Asia for their supply chain, and then also some manufacturing. They reorganized that, brought some of it back into LATAM. So they're not necessarily positioning for growth globally, but they are looking to manage the risk. And so they've got a long-term orientation around how to do that, and we can help them.
I'm curious, with regards to the growth, though, the potential growth of their business and what they're looking for, has that sort of accompanied an increase in hiring? I mean, how do they feel right now about taking on the long-term costs of bringing in new employees?
So, it depends on what their growth strategy is. Certainly adding human capital is one of them. Making investments into their operations to grow is another. And then looking at other technologies like AI is the third way they think about growth. And, I think there's been a lot of hype around AI. What we're seeing is that our clients are actually growing through that hype and actually using AI to improve their efficiency and to manage their companies more effectively.
Well, we only have about a minute left, but I'm curious about what exactly, that means in terms of how that translates to some of these companies. Does that mean they're hiring fewer employees, or just that they're able to maybe unlock some productivity gains there?
I think that they are unlocking productivity gains, they're getting more efficient, and they are thinking about the impact that it is having for the workforce. And so they want to make sure that where it's appropriate, that they are upskilling, reskilling, and retraining.
Wendy, great insights, and I always love the type of work that people like you do, because I feel like that's way more representative of what's going on in the economy. Wendy Stewart, President of Global Commercial Banking for Bank of America. And we're going to look at the other side of this to a certain extent from the investment perspective. A conversation up ahead with the CEO of Wellington Management, Hynes, who joins us in just a second to discuss the firm's position as one of the world's largest privately held asset managers and how they're advising clients in the current climate. That's coming up next here on The Close. Stick with us. This is Bloomberg. 3:30 p.m. in a cloudy New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on these public equity markets. But let's talk a little bit about private markets, because we're continuing to see the major investment houses increasingly pushing into the space. And Wellington Management, which oversees about $1.3 trillion, is no exception. In the last year, the company has been building out its private markets teams, nabbing Hamilton Lane's Alex Bem to lead its foray into buying and selling PE stakes. That happened just last month. And that's after they recruited a new head of private investments capital formation from Goldman Sachs, and after poaching a private credit team from PIMCO. Let's discuss all of this with Hynes. She's the CEO of Wellington Management, one of the largest privately held asset managers, a very busy woman. Jean, it's great to see you.
It's great to be on. Thank you so much.
And that's not even the extent of it. I mean, you've also partnered with Blackstone and Vanguard to launch interval funds that hold private assets for retail investors. So when you wrap it all together and you think holistically here, what are you hoping to achieve when it comes to the private market space, what Wellington's place in it will be, and how long do you think that timeline is?
So we've actually been in the privates business for 10 years, so over 10 years. We started our first foray into it in 2014. So we do go back. And that was based on an investor who was on the public side, recognizing that companies were staying private longer. And that may seem very obvious now. And back in 2012 and 2013, it was not obvious. And I think our management team at the time thought we were an active manager of public security. So it was a big foray for us to go into the private markets. I think over the past 5 years, we've really said, what is our strategy in privates? And we began to build out more capabilities. We invest in companies before they go on the venture side, before they go close to IPO. We do that in biotech. We do that in climate technology. And so adding on to secondaries was just natural. And then over the last few years, as you said, we've also done that on the private credit and real estate side. If you think about our footprint in the public markets, we are very balanced between equities and fixed income capabilities. And our private strategy is just an extension of that. So there are definitely areas that we're not interested in or we wouldn't have an edge in, but we believe the areas that we've gone into, we do have a real edge. And it really, as investors, provides us the full picture of what's happening in the economy. That's our goal. Like, it's our responsibility if we want to provide the best investments to all our clients on the public side and the private side. You have to know what's going on in the economy.
Well, it's really interesting, that strategy of you start the relationship early, of course, on the venture side, and you sort of see it through there. But I have to ask, I mean, I just ran through a laundry list of all the hiring you've been doing. Are you happy with the team that you have assembled right now, or are we going to have to add to that intro in the next few months? So if you take, we only actually have one investor that has been on the public side. So all our investors, we have about 40 of them that we've recruited since the late teens to be on our, to build our private capabilities. We made that a very deliberate decision that we wanted to make sure we had people with private experience. And we couldn't be more happy with the teams we've recruited and the capabilities and the expertise they provide. But we have a 10-year plan in privates, and so I would expect that over time we will continue to either add to those teams and think about them as a platform, and maybe go into other areas that make sense from adjacencies to our current business.
I am curious about your hedge fund strategy. It's more of a multi-strat strategy now, and I am curious as to why you gravitated there instead of sticking with more of the kind of the single pillar strategies. Yeah.
So we've been in the hedge fund business for 30 years. I actually personally was a hedge fund investor for 20 years, and so it's one of our long heritages of doing long-short investing at Wellington. And you were right. We started with single strategies. We started with many sector-based funds. I was a healthcare investor, so it made sense. In 2019, and maybe this is a good way to tie in the privates, in 2019, we did an analysis of what do we want our alternative strategies to be. So we're not new into hedge funds. As I said, we were already in privates, and we took about a year to study what do we want to do? And that's when we sort of separated those businesses from the equity business that they were in, and we named leaders. And I couldn't be more happy now, 5-6 years after that those leaders have taken those businesses to sort of new levels. In terms of the hedge funds, one of the things that came out of that hedge fund analysis was how do we bring this business to be a great long-term business, and how do we have a flagship multi-strat hedge fund? So we're very happy that 5 years later we've had a multi-strat hedge fund, but we launched it in a vehicle that made more sense to be able to really then hire investors. And we are hiring talent. I said we're hiring a lot of talent in this market, in our London market.
Do you have any concerns, though, with regards to the multi-strat focus, that it's going to be a little bit harder to just kind of keep watch on things, make sure that the strategies are doing exactly what they're intended?
Yeah, so we have, so the part of our strategy that makes most sense and is aligned with our long-term is that if you have a healthcare investor, if you have an industrials investor, if you have a consumer investor, they're investing in their sector. And then we also have a very long-term asset allocation solutions team that is the one that is putting those solutions together. So they're the ones that are overseeing from a portfolio management, from an allocator perspective, how do I do risk management, how do I do risk controls? But we let the investors manage the money and manage what they do best.
Speaking of investing in healthcare, I want to talk a little bit about your background, because my understanding, you've been at Wellington for 35 years. Yeah. You've spent several of those decades within healthcare and biotech, first as an analyst, then you were a portfolio manager. And I think that's a really interesting pedigree, because now you have the top job. So I'd just love to hear a little bit about that, how that experience actually in the markets, investing money, sort of informs what you're doing now, running the whole shop.
So I spent 3 decades, as you said, being a biotech and pharmaceutical analyst. And then in 2013, I took over the Vanguard Healthcare Fund, and so started investing more broadly in all of healthcare. And in 2014, I became one of the firm's managing partners. So one of the most important things to know about Wellington Management, we're a private partnership. There are very few private partnerships remaining in the asset management industry, and there are 3 managing partners that oversee the governance. So if you asked me in 2014, I thought, well, I love investing. I have these strategies from long-short biotech to Vanguard Healthcare, and then I added this talent part of it that I really loved. I love that being a managing partner and really overseeing the talent of the firm and the talent processes of the firm. And then over time, as I worked really closely with the CEO, it just sort of grew on me. Like one, that I had the skill set to do the CEO job, and then really trying to figure out how did I want to spend my last decade at Wellington? If I had spent 30 years, how did I want to spend my last decade at this great firm? And so I moved into the CEO job just about 5 years ago.
All right. Well, it looks like you're doing a pretty good job, and I hope to have you back soon. We can talk a little bit more about it.
Thank you so much.
Thank you. Hynes there, the CEO of Wellington, here as we count you down to the close here on this Wednesday afternoon. When we come back, a closer look at shares of Apple decoupling from the NASDAQ 100 as the AI disruption ripples through the market to Apple's benefit. It's our stock of the hour. We explain next, right here on the close, right here on Bloomberg. Our stock of the hour today is Apple. The shares had been up about 1% on the day, pulling back just a little bit, but they've actually been on a relatively decent run, coming unmoored from the NASDAQ 100 by the most in about 2 decades, a possible symptom of Apple actually kind of staying on the sidelines in this AI arms race. Joining us right now is Bloomberg reporter Ryan Vlastelica. Has a great story on the Bloomberg terminal here about that drop in correlation between Apple and the rest of the market. And I found this story intriguing because Apple got criticized for months, for quarters, really, for not really articulating an AI strategy, at least for the moment, and now seems to be working to their advantage. Explain.
Yeah, thanks for having me on. So absolutely, all of the major AI cross-currents that have been going on in the market over the past few weeks, Apple is really remarkably out of the way of all of them. So if you're worried about big tech CapEx, Apple isn't doing that spending. If you're worried about software being eaten by AI, Apple is in software. If you're worried about AI disruption more broadly, Apple isn't really in the line of fire for any of the major services that we've seen come out. At the same time, if you're optimistic about AI, people are probably going to be accessing AI and all the various services through an iPhone, through some other kind of Apple product. So it does seem like it is avoiding a lot of the major reasons people are selling tech, and it is still well positioned for potential upside.
It is such an interesting point when it comes to CapEx, because that has really been the bugaboo, if you want to call it that, of a lot of its big tech peers. Apple, relatively low when it comes there, but it's not like it doesn't have potential headwinds, Ryan, especially when you think about what we're seeing in memory chips, those skyrocketing prices. I have to imagine that's coming directly for Apple's margins.
Yeah, so in its recent results, it did say that this is going to be a bigger issue as we move throughout the year, I guess as these different contracts start lapsing. But certainly this is a major focus. We have seen huge rises in memory prices. I think they've gone up 4 or 5 times, even more so over the past several months. This is a byproduct of all of the AI spending that is going on. So even though Apple isn't participating in that, it is seeing an impact here with a high cost of components.
But there is a question here, Ryan, too. At some point, I mean, they will have to make maybe a little bit more of a push into this space in a way that actually does mean they're going to have to dig into their own wallet and actually invest in it. There's been a lot of talk here about what the heck's going on with Siri, and Mark Gurman has done some great reporting about the fits and starts of them trying to improve that. And of course, now the partnership that they have with Alphabet to try to make that a little bit more AI focused.
Yeah, so if Alphabet is providing all of the tech for Apple's AI, that almost gives them a little bit of a pass. They don't necessarily have to develop their own in-house LLM the way that Microsoft and Meta and Alphabet and Amazon are doing. It is able to sort of take advantage of the work that Alphabet is doing, or that OpenAI is doing, or Anthropic. All of these different services do have apps that you can use on the phone. It has talked about doing different deals with OpenAI in the past, and of course it announced that big multi-year partnership with Alphabet. So even though it isn't doing the kind of spending the other companies are doing, it's not like you can't access AI on the phone.
All right, Ryan, really great reporting. Such an interesting story. That is Ryan Vlastelica of Bloomberg News. And you think about Apple, I mean, they were kind of a little bit made fun of, at
Yeah.
least when it comes to some of the sell side for what they were doing in AI, falling behind, not really spending up the way that some of their peers were. It's just interesting how the tables have turned.
But then we saw that last earnings report, right? And the idea of a reminder of just what a cash cow this business is. It may not be sexy anymore, but it is throwing off cash like no other. And of course, a lot of talk now about potential succession planning for Tim Cook, which maybe potentially could reinvigorate the stock even more, assuming the market actually likes whoever the board picks.
Yeah, it's going to be fascinating to see how that conversation develops.
And one day you will actually upgrade from your iPhone 5 or whatever you're on.
I never will. No,
Yeah.
I'm going back to a dumb phone. My iPhone is basically a dumb phone at this point. In any case, the closing bells are up next. We're gonna take you there with Dina Ting. This is The Close.
The market has been able to broaden very nicely into other sectors while maintaining its relatively upward slope. I mean, the S&P hasn't really done much at all this year, but still, compared to the scenario where the Mag 7 drags down the index, even though the market's broadening, I think this is basically a win.
Jurrien Timmer over at Fidelity, kicking us off to the close just about 15 minutes ago. The rally, a relatively strong rally that we had earlier in the day, giving back some of those gains, but still, all the major indices here in the U.S. in the green, Katie.
Yeah, actually a little bit reinvigorated as we head towards that closing bell. The S&P 500 higher by about 0.6%. We're off our highs of the session of about a 1% gain, but certainly off our lows. I will note that volume is pretty low on the day compared to our 30-day average.
Where is everybody?
I don't know. They're on vacation. They're off, skiing, hopefully on the East Coast here. You can see, though, when it comes to Bitcoin, I feel like we need to keep an eye on it.
Yeah, why do you keep putting that on the board?
Because it keeps going lower, and I just want to know how low it can go. We were back above 70,000 at one point last week, but that feels like a while ago.
Yeah, it'll be interesting to see if anything breaks it from that doldrums there. Investors are, at least in the equity market, trying to find some bargains there. You are seeing a bit of a rebound in software stocks, but industrials, energy stocks leading the charge here on this Wednesday afternoon. Dina Ting, she joins us right now to take us to those closing bells, head of global index portfolio management at Franklin Templeton. And Dina, I do want to get your thoughts here on the global trade. But before that, I want to get your comments first on what's been going on here in U.S. equity markets with regards to that, I guess we'll just call it an AI sell-off, or at least a software sell-off here. And the idea that, did that go maybe a little bit too far, too fast?
I think part of that is the rotation and understanding what each player actually brings into the table. And it's natural for to have even some correction along the way, because things are still being defined, especially as you go through the multiple layers of AI, to be able to see who will actually become a clear winner. So just think of this like the Industrial Revolution of a century ago. So this is for the AI revolution. There needs to be some discipline to understand what value each player brings, but also to kind of see how fast things evolve. So which may change who the winner and loser.
There's been a lot of discussion about where you invest in that AI trade. Obviously, the easy trade for at least the last 3 years was just kind of the picks and shovels, if you will. But as people start to look at the people who might get disrupted, the companies, I should say, and more importantly, the companies that would do the disrupting, is that going to be in the traditional technology industries, or is that going to be outside of technology?
Yeah, I think people think that AI leadership is one race, but in reality, it's a multi-layered with global opportunity beyond just the US, right? Whether it's starting off with the infrastructure, the chip, the power, to the application layer and industrial deployment, I think all that plays a different factor. And I think investor tends to look at it only from a US perspective, which yes, it does lead in the model development and on the design on the chip. But if you look at countries such as Taiwan or South Korea or Japan, they do play a factor in this AI kind of like super hyperscaler cycle that we're seeing.
Well, that's what I was going to ask. When it comes to investing in AI, looking globally, and you're right that U.S. investors in particular have a very strong home bias that extends to AI as well. What part of the AI trade might you find if you look to places like Taiwan? I mean, you think about what's going on in the U.S., NVIDIA, sort of the picks and shovels chip makers are all the rage. But what might you find if you take a look over at Taiwan, for example?
Yes, so Taiwan is a big partner to NVIDIA because NVIDIA is one of those fabless, so they don't actually manufacture that. So their partner, TSMC, is the one who actually manufactured these advanced semiconductor chip. And the reason why Taiwan play a big factor and is quite central and is not easily replaceable is because these are a very capital-intensive industry. The high barrier of entry and the level of sophistication it requires. So it's not due to the trying of others, but it's due to discipline and the fact that they built a highly strong competitive advantage that is hard to displace. And it's not even in what we were found interesting is actually getting stronger, right? If you look at the market share, it's actually growing. These companies who are the leader in each of the part, whether they're on the memory, high bandwidth memory, like those in Korea, or like in the advanced manufacturing in Taiwan, they're growing at 80 to 90% rate, which is a very strong growth rate. And Taiwan, in terms of semiconductor export, it grew by 30% this year. So they have been creating this different layer that's harder to displace.
And it's interesting. I mean, part of the reason that I think U.S. investors do have such a strong home bias is because that's where the performance has been over the past decade or so. Maybe that narrative started to change a little bit in 2025. But I mean, what is the advantage of diversifying, of looking overseas, if a lot of these AI gains, at least from a performance perspective and a place within the benchmarks that Americans invest in, what is sort of the motivating factor of looking outside?
Yeah, because each one has a different leadership across. So you mentioned performances, but if you look at South Korea, for example, they actually performed over 90% last year, and year to date is about 26%. So they have been delivering on the performance as well. But if you look at where everyone fits, right? So if you go into like the AI, so semiconductors everywhere, from the car to appliances. But the one that we focus about is on less AI, like the higher performances, both on the memory as well as on the packaging and others. So if you look at the Taiwan, if you look at Korea, and if you look at Japan, for example, which years ago was the global leader in manufacturing for semiconductor, they are trying to recapture that opportunity again by focusing both on like the more mature, but also on the more sophisticated one. So they're going with the very small 2 nanometers strategy.
All right, Dina, great stuff. Dina Ting, head of Global Index Portfolio Management at Franklin Templeton, counting us down to the closing bells with a big focus, of course, on AI. But Katie, we should also point, there's been a big focus on the economy as well. We're going to get a big GDP report on Friday. We got the Fed minutes today, which kind of rattled a couple people because they say, oh, wait, is the Fed not going to cut rates? But I don't know, the economy is holding up. That should be a good thing. So if you don't get a quarter-point rate cut, is that really going to be?
I mean, it's interesting that it's not necessarily showing up in these markets, but I will say you're absolutely right that these Fed minutes were a lot more interesting than normal. Usually they're backwards looking. We know that. These are still backwards looking, but we know that there's a lot of dissent going on within the Fed so far.
Well, one of our producers called it spicy. I don't think we've heard that out of a Fed minutes in quite some time. As we move closer to the closing bells, a slew of earnings set to hit the wire in just a matter of minutes. Our full coverage starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell with a global simulcast. Carol Masser and Tim Stenovic pop up on the screen. Welcome to our audiences across all of our Bloomberg platforms. That's television, that's radio, that's our partnership with YouTube, parsing the most crucial moments of the day. Carol Masser, we had a little bit of a rebound rally here on the day, some of the gains being given back, but green across the screen for all of the major U.S. indices.
Yeah, bouncing around in a big way. We did get those Fed minutes earlier where we did see several officials, a little bit more concerned maybe about inflationary pressures.
Are you concerned about inflationary pressures?
Yeah, I live with inflationary pressures every day.
I was told.
Don't you feel it still?
The disinflation is happening.
Yeah. Who told you that?
You feel that?
Prices are not going down. Have you bought paper towels lately?
The prices don't go down. Remember, the rate of acceleration changes.
I know.
Carol's told me many times.
Reusable towels.
I know. I am. Actually, my husband, we got lots of reusables now.
No, thank you.
Hey, I'm interested in the way that AI is affecting the companies that are reporting after the bell, especially a company like Booking Holdings, Avis Budget. You know, we got people in the newsroom telling us they're using AI to book hotels, to book rooms, to like come up with incredible European vacations within 15 minutes.
Go to Milan to see the Olympics.
I was trying to book something last night.
Did it work?
No.
What did you use?
Well, it wasn't AI. I was just doing it the old-fashioned way.
With the chatbot.
That's why it didn't work.
Yeah, I don't know.
You need a young to show you, Romaine,
A young.
on the agentic thing.
One of those
I need a
youngins.
young.
Yep.
Anyway. All right, we are getting a lot of earnings after the bell. Molson Coors, Booking, Avis Budget, Occidental Petroleum, DoorDash, Cheesecake Factory, eBay, Carvana, Edison, and Omnicom, just to name a few, as you get the closing bells here on this Wednesday afternoon, finishing off the highs of the day, but green across the screen. The S&P 500 up about 0.6%. The Dow up about 0.3%, a 0.25%, we'll say. The NASDAQ Composite up about 0.8%, and the Russell 2000 finishing out the day higher by about 0.5 percentage point.
All right, interesting. That's the small caps. Let's go back to the S&P 500, guys. Hey, most names actually by the close higher in today's session. 317, Katie.
Which one's your favorite?
To the upside. I don't have favorites. I love them all. 185 to the downside, one unchanged.
We're getting results right now out of Booking Holdings. Speaking of travel here, the numbers as they hit the wire, and this takes a while to pull up, looks like pretty much in line with estimates. EPS at 48.80, pretty much in line with the average of street estimates. $2.2 billion, just a nudge higher than what the street was looking for. Excuse me, that's the EBITDA number. Revenue is $6.35 billion, just a nudge higher than the average of street estimates of $6.13 billion, and gross bookings $43 billion. The street was looking for $41.99 billion. So just slightly above the average of street estimates. Not a whole lot of pop in the shares there, but we're going to dive deeper into it, Katie.
No, you can see the shares higher by about 0.9% after market. Not too much movement, especially when you consider the magnitude to which shares have fallen so far this year, Tim. I mean, when it comes to the total return basis, down by about 20% or so, but you can see now starting to move a little bit more as traders digest some of these figures.
Glenn Vogel trying to get ahead of the narrative that generative AI is a threat and instead an opportunity. In the press release, he says, and this is the CEO of Booking Holdings, quote, "We remain focused on our key priorities, especially advancing our use of generative AI to enhance the value we deliver to both travelers and partners."
There's that word.
Sorry?
Yeah, there's that word again, AI.
Yeah. Well, look, I mean, if you're you have to change the narrative, I guess, or you have to talk about how you're embracing it, or talk about how it's an opportunity, not a threat for a company. We see a lot of companies doing this right now when investors are scared of the effect of AI on their company.
Yeah, you talk about it, but is it really, going to be helpful, or is it going to be more of a threat? I mean, right now you've got the stock just up about 0.7% here in the aftermarkets. Again, some of the outlook from bookings sees first quarter room nights up 5 to 7%, sees year gross bookings growth low double digits, and sees first quarter gross bookings up 14 to 16%, Katie.
Yeah, you can see, again, now
Outlook
shares flat. So we're going to have to see, of course, maybe if we get some more clarity when it comes to the call, maybe that'll provide a more clear direction. But when it comes to the day that was, let's take a quick look at the sector level as well, because you can see there was a lot of breadth for relatively small movements for the benchmark overall. Energy was your outperformer on the day by a mile, higher by about 2%. Utilities, your big loser, down about 1.7%.
Well, let's go back to the travel space and take a look at rental car company Avis Budget. Those shares down about 7.5%. The company missing on revenue in the most recent quarter, $2.66 billion. The street was looking for $2.74 billion. A net loss as well, with the company saying that reflects a $518 million asset impairment. The company, though, did say its per unit fleet cost down about 21%. But here's your forecast for the full year. The company says adjusted EBITDA, a range of $800 million to $1 billion. The top end of that range is below the average of street estimates.
All right, let's get a read on the advertising and marketing world. Omnicom out with their latest results. We're seeing the stock move a little bit here in the aftermarket. Fourth quarter revenue, folks, that was a beat, $5.5 billion versus the street estimate of $4.52 billion. Fourth quarter adjusted EPS a little bit light by 2 pennies, $2.59 a share versus an estimate of $2.61. And you can see shares of Omnicom, they are down about 1.25% here in the aftermarket. All right, let's go to some specific stocks on the move. In fact, this one, we were breaking down the earnings after the close yesterday, and this was a top gainer in both the S&P and the NASDAQ 100. We're talking about Cadence Design Systems, finishing the day up about 7.6%. The company reported fourth quarter results that beat expectations. They gave an outlook that is seen as positive. Wall Street's been weighing in throughout the day. Morgan Stanley, that is, and Piper Sandler lowering their price targets on the stock. Rosenblatt upgrading the stock to a buy and raising its price target to $360 from $335, stock closing at about $305 a share. Let's move on over to Wingstop, because that one.
I love this. Yeah.
So that's my gift to you.
Okay.
You're welcome.
Thank you.
All right, Wingstop up about 10%. It was up as much as 20% intraday. This is, of course, the restaurant chain specializing in chicken wings. Reported adjusted earnings per share and total domestic comp sales growth for the fourth quarter that beat consensus estimates. The results kind of a welcome surprise, if you will, after analysts had warned that the chain's heavy exposure to lower income, Hispanic and younger consumers groups that have pulled back the most on dining out could weigh on results. But this one, definitely an outperformer. And guys, we have some more earnings.
We do. Two notes. So Wingstop just opened in Hoboken, so that's huge. Also, we're getting DoorDash earnings right now. They see first quarter marketplace gov between $31 billion to $31.8 billion. That is a red headline on the Bloomberg terminal. The estimate had been for $30.75 billion. When it comes to their fourth quarter EPS, it looks like that did miss estimates pretty materially. 48 cents, that was the figure for EPS for the fourth quarter. The estimate had been 4.55 cents. When it comes to revenue, also a slight miss there. When it comes to the first quarter outlook for adjusted EBITDA, $675 million to $775 million. That is a big range, and it's actually below the estimate of about $800.1 million. You can see the shares reacting right now, currently lower by about 5%.
Okay, I'm looking at shares of eBay. They're higher by about 3.4%. The company out with its latest results, but also some news. It will buy Depop from Etsy for about $1.2 billion in cash. In addition to that, fourth quarter net revenue coming in at $2.97 billion. That's above estimates of $2.87 billion. Fourth quarter gross merchandise volume coming in above estimates. Fourth quarter active buyers coming in above estimates. Fourth quarter adjusted EPS coming in just above estimates. The company did raise its dividend, and it matched Bloomberg projections. Once again, fourth quarter EPS from continuing operations beating estimates. Shares higher in the after hours ever so slightly. The company sees first quarter net revenue $3 billion to $3.05 billion. That did beat estimates of $2.79 billion. And once again, the company's going to buy Depop from Etsy for about $1.2 billion in cash.
At some point, we got to go back and talk about what the heck's going on with Etsy. But I do want to talk about Molson Coors, the beer maker out with its earnings right now. 4Q net sales $2.66 billion, relatively in line with estimates, maybe a smidge light from the $2.7 billion average of analyst estimates. But underlying EPS did beat at $1.21 a share. The street was looking for $1.15. Overall, though, we should point out net sales were actually down by about 3% year over year, in line with expectations. But of course, this is a company that's been struggling a little bit here with a decline in alcohol consumption, particularly in certain sectors of the beer market.
All right, guys, let's go to Carvana, which was on fire last year, but we've seen a bit of a different trade this year. And I see the stock down about 15% in the aftermarket. Wow. Yeah, exactly. Fourth quarter adjusted EBITDA, $511 million. That's a miss. Street was looking for $535.7. And fourth quarter revenue, $5.6 billion. That is above street estimates. And fourth quarter adjusted EBITDA margin, 9.1%. That's a miss. The street was looking for 10.4%. We'll look for some outlook on this one, but investors not pleased. Right?
A lot of short interest on this stock, too. Yeah.
Right.
Yeah.
So we're definitely going to see some movement there. Yeah. All right, guys, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Katie and Romain continuing there on the close on Bloomberg TV. Are you?
Yes.
Are you sure?
That's the plan.
All right. Feel free, Katie, if you want to come over and play with us.
Good to know.
It's all business on this show. And our coverage continues here on Bloomberg Television, a deeper dive into some of those earnings. We just got Booking, and earlier today, we actually got earnings out of travel and leisure. We're going to talk about the vacation business with the CEO coming up after the break. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A bit of a rebound rally in U.S. financial markets today with the S&P posting a gain of about 0.6%. But I do want to draw your attention to Dow Transports. The third straight day we've seen them outperform both the S&P and the NASDAQ, as it's now heading towards a fourth straight month of outperformance of the broader market here, reflective of some of that rotation trade that we continue to see out of some of the big tech names and into, I guess, some of the more pedestrian economic names and or economic exposure names. And of course, some of that being fueled today, Katie Greifeld, by some relatively decent economic data ahead of a big GDP report on Friday.
Absolutely. Looking forward to that, Reed. But let's revisit some earnings stories that we got in the past 24 hours or so. I want to start, of course, with Palo Alto Networks. Their forecast went over like a wet balloon. You can see shares falling by 6.8% on the day. Actually, a totally different story when it comes to Garmin. I'm wearing one of them right now, and they had their best day since 2024, higher by about 9%. Their full year 2026 forecast beat estimates. And we end with travel and leisure. Shares finishing about 3.5% higher. They were 11% higher at one point, Romaine, but even still that 3.5% gain, that's good for an all-time high. That's after their first quarter outlook came in above consensus.
And of course, Travel and Leisure, the world's largest vacation ownership company. I'm pleased to say the president and CEO joins us right now. Michael Brown, fresh off of their earnings report earlier this morning and fresh off a record close of the stock. You know, we were joking a little bit earlier on this program, Michael, as to whether people were continuing to spend on travel, at least based on the properties that you oversee. That does appear to be the case. What's going on?
Well, that's right. We saw solid demand the first three quarters of 2025, and that just continued, if not accelerated, in Q4. What I'm happy to say is we've gotten ourselves halfway through Q1. That momentum in leisure travel continues. We're not seeing that abate whatsoever. And I know there's a lot of conversation around the K-shaped economy, but our consumer average household income well above 100,000 and FICO's above 740 sits at the top half of that. And they're continuing to travel, and we're not only seeing it in Q1, but we're seeing it in forward bookings heading into Q2.
How sticky are your customers, Michael? I mean, hypothetically, if there was some sort of economic softness here, do those folks, do they stick around?
Well, I think two economic realities have proven the stickiness of our consumer to be above what you would see in general leisure travel. First of all, in an economic downturn, 80% of our consumers have fully paid for their ownership. So the financial advantage of staying at home doesn't really help them because they've already paid for their ownership. So what's the disadvantage of going on vacation? You might see a change of trend to a drive to versus a fly to. And that's one clear advantage of why our consumers are sticky. The second is with 80% having fully purchased their ownership, when you have 4 straight years of mid-single digits on average inflation, the price you paid in 2015 or 18 is screaming value. So when you come back and you see the value you've already realized from your ownership, it's a lot easier to justify buying more with us.
I want to talk a little bit about demographics here and how you expand your client base, because the word timeshare, you tend to think of sort of an older traveler, but we know that, millennial, Gen Z, that sort of segment of the population, it seems like every industry is trying to seize upon that. So I'm wondering what that means for travel and leisure, how you're thinking about that segment.
Well, we are really doing it as an industry and as an individual company in 2 different aspects. In 2008, I know that's going way back, this industry fundamentally changed. Now 85% of all sales done today are done by hospitality companies that recognize that all demographics are super important for the long-term growth of the industry and for our individual companies. But for us specifically, what we've begun coming out of COVID is we've repositioned the company to be more niche and to really fit individual cohorts by launching new brands on names that you would recognize that really match leisure travel to lifestyle. Sports Illustrated for the sports enthusiast, Eddie Bauer for the outdoor enthusiast, and Margaritaville we really reinvigorated for those that love that Margaritaville on Margarita on a beach, listening to some great music. Everyone has their own form of travel. We're just now matching a lifestyle that fits their individual needs with the launch of new brands. And those new brands are really proven to be successful in how we grow our business.
Yeah, I have to say, that does not sound so bad right now as we sit in a slightly less frigid New York City. But talk to us a little bit about, the portfolio of brands that you're working with now. You just listed quite a few of them. I mean, are you happy with that makeup? Are you looking for, more additions come 2026 as we get deeper into it?
New additions, yes, for sure. But let me just step back as to the philosophy of the company. We're all about incrementally growing through strong execution and providing to the street a lot of consistency and reliability in our performance. And that doesn't happen if you take your eye off the ball. We've been very methodical in adding a core. Then we added Sports Illustrated, and then we added Eddie Bauer, proving each time that we can execute against the brands we've become stewards of, and then adding brands on top of it. There's plenty of white space out there for us to add incremental lifestyle brands or at a different demographic chain scale, and we will do it maybe later this year or early next. But first and foremost, we want to be great brand stewards and execute against our business plan and return to shareholders what we've promised them. And you don't do that by taking on too much at one time. And I think we're starting to prove to the market that we know how to take on new brands, be stewards, and then execute, and then ultimately move to our next brand that we'll bring on.
Michael, I do want to just talk about the potential uptake of new customers, folks that aren't now in that T&L ecosystem. There's been a lot of talk. I mean, when we talk about economic conditions, there's been some talk about tax refund season, whatever potential benefits might accrue coming out of that budget bill from last year. Have you actually looked at that as an opportunity? Are you actively targeting those potential people who might potentially see some minor windfall of money to spend?
It definitely helps, but I could point to about 6 or 8 economic factors that ultimately support the consumer confidence index. And when that index is going up and to the right, that's good for business, and it encourages more leisure travel and more spending when you're on leisure travel. So I think tax refund is supportive, no question. We'll see where interest rates go. General macroeconomic conditions are very supportive. And obviously, we've seen the Dow move up above 50,000 a few times and teeter back and forth on both sides of it. That general feeling of good economic conditions, especially in April when tax returns come, give people a lot more confidence to travel into the summer season with the World Cup coming, celebrating America's 250th birthday. Lots of reasons to book at our resorts.
All right, Michael, great to get some time with you on a very busy day. That is Michael Brown. He is the president and CEO at Travel and Leisure. Meanwhile, let's get to some other earnings breaking after the bell. We start with Occidental. Their fourth quarter net sales beat estimates. They also beat when it comes to adjusted EPS, coming in at 31 cents. The estimate, for context, had been for just 11 cents, also beating, of course, when it comes to their adjusted net income there. So you can see shares not really reacting too much right now, but very, very slightly positive.
A little bit more of a more prominent reaction in shares of Cheesecake Factory cake, down about 6.5%. The company says that in the fourth quarter, adjusted EPS did come in line with estimates at about $1 a share. Revenue, though, was up about 4.5%. 4%. That also does appear to be a beat, actually. But restaurant comp sales, they were down 2.2% year over year, and that was worse than what the street was looking for. They were looking for a decline of about 0.8% here. So it looks like at least about double to triple the percentage point decline in those restaurant comp sales weighing there on the shares of Cake.
Yeah, it's currently cratering when it comes to Cake shares, down about 6.5%. But coming up, we're going to stick with the travel conversation. We're going to break down results from Booking up next. This is The Close on Bloomberg. Well, we're taking a look at shares of Booking in the after hours. That's after results came from the online travel company just about 23 minutes ago. Nicole D'Souza of Bloomberg Intelligence joins us now with a little bit more context. So you take a look at the fourth quarter. Gross bookings, it looks like they beat there, also beating when it comes to revenue. So not bad overall. Give us some context about what you're thinking when it comes to the look ahead. Their first quarter revenue forecast, 14% to 16%. Room nights looking for growth of 5 to 7% there. What do you make of it?
So I think fourth quarter was strong. I think that we are seeing an improving U.S. travel backdrop, which has really weighed on a lot of travel names throughout 2025. I think in 2026, we're expecting U.S. travel to be strong. We have things like the World Cup coming up. I think the guidance maybe could have been a little bit stronger for Q1, just given the U.S. travel has improved, and also where we're expecting a little bit of a boost from the Winter Olympics, which are happening now.
I am curious just about the business model. I mean, we've seen, in the old days, if you're looking for a hotel, you went on some of these sites, but a lot of the hotel sites directly have sort of beefed up their sites to go to the consumer. Same thing, of course, with the airlines as well. Is Booking in partnership with some of those names, or are they competing against them?
So they are in partnership. They work very closely with those names. I think maybe the biggest competitive threat coming up is really these AI players and these large language models. As travel planning moves from traditional search to AI search, we could be seeing a threat to top of funnel traffic for a lot of these online travel agencies.
Absolutely. I mean, for a company like Booking, we've seen the AI scare really flatten a lot of industries over the past couple of weeks. How does a company like Booking sort of future-proof against that possibility?
So they have rolled out a lot of their own AI trip planning options. So instead of going to ChatGPT, you can go to Booking, and it can really recommend a great, based off of their own reviews on their site, they can recommend a really good itinerary. They can also directly book with Booking on their platform, which is an advantage right now. We haven't really seen that yet with a lot of these LLMs.
So with regards to your analysis, though, is Booking a growth story right now?
Yes, we've seen them really expand their supply. So they've moved on from traditional hotels. They're now looking also at alternative accommodations. And so they've grown. I think room nights grew in the quarter about 9%. That supply growth has really benefited top line growth. And so I think we're expecting that to also be a benefit in 2026.
All right, Nicole D'Souza over at Bloomberg Intelligence, a closer look at the earnings that we just got out of Booking. Some breaking news actually crossing the wire just a little while ago, Katie Greifeld. This involving Live Nation. The share is down about 4% in the after-hours trade. That lawsuit that had been brought by several states here, basically effectively kind of an antitrust suit with regards to their ticket pricing and practices. We're now learning that a judge has said some state claims in that case can now advance. We don't have a whole lot of details on this, but the knee-jerk reaction, you see the shares in the after-hours to the downside.
Yeah, absolutely. This case to go to trial on ticketing and their amphitheaters as well. Shares were down as much as 7%, but still markedly lower. Let's talk a little bit about Carvana. Shares now down about 21%. We know that their fourth quarter adjusted EBITDA missed estimates there. Higher costs also really trimming their profits overall, and you can see that reflected in the after hours.
And then, of course, you had that big short seller report, what was it, last month or so, and the shares have been under pressure. I'm looking at that. I checked it out. A 22% decline. If this holds, this would be one of the biggest one-day drops we've seen in the stock in more than a year.
Yeah, well, we know a lot can change between now and the opening bell. We'll keep an eye on that. Keeping an eye on shares of eBay as well. A much different story, actually higher by about 7.7% right now. They beat on their forecast. It's also interesting. They announced that they're going to buy Depop from Etsy. Yeah. That's not, dragging down shares at all. That seems to be helping to sort of boost
Why is DoorDash down? My producer, she orders from DoorDash every single day. DoorDash should be soaring based on her alone.
Rising costs, apparently winter storms in the U.S. sort of crimping business.
All right, when we come back, an exclusive conversation with the CEO and president of the Coach brand, Todd Kahn. We're going to talk tariffs and the big rebound in the brand's cachet. This is Bloomberg. Tapestry. It's had a meteoric rise in the last year, and a major part of what's propelling the stock higher is the strength of one of its two brands, Coach. This morning, Katie and I got to catch up with Todd Kahn, the CEO and brand president of Coach, to discuss how they're managing tariffs, their focus on the Gen Z customer base, and what comes next after this phenomenal growth. Take a listen.
We focus very much on trying to figure out Gen Z. I often say we're an overnight success story 6 years in the making. And Stewart and I, many years ago, recognized, among other people at Coach as well, that we were too much often considered a brand for everyone and hence a brand for no one. Mm-hmm. And we became extraordinarily focused on Gen Z. And part of our focus was listening, learning, doing a lot of sometimes what I call big data and little data. Big data is we're a direct-to-consumer business. We have millions of customers. We have a lot of data from them. Little data is sometimes going into people's houses, doing shop-alongs with them. They don't often know which brand they're speaking with, and listening to them. And we gain real insight from them. And so what I often say is, I don't want to supplant the gut of our creatives. I just want to create an informed gut. So that's what we're doing, and that's what you're seeing working.
How much of it is being that tastemaker, trying to anticipate where the trends are going to go versus, following the logic, following the data and seeing what is resonating with Gen Z, for example?
Yeah, so what we do, again, Lou said it, we have to remain curious. Also, what I often talk about, we have to remain humble. We don't have all the answers. We have a sense of where fashion is going. We pick up cues. Our creatives, our designers, our merchants are shopping the streets of Shanghai, of Tokyo, of New York, of LA, and seeing and listening to trends. We are not just following trends. If you're just in the following trend business, you're not really a significant fashion house. So we're listening to what they like. We understand there's functional needs, and Coach, I will say, in our 85-year history, excel at having an incredibly high-functioning bag. But what draws you to our category, no one needs our category. You can carry your stuff in a paper bag. You can carry your stuff in a $50,000 bag. Mm-hmm. Of course, there's material differences, but ultimately, it's an emotional purchase. We want to make sure our bags talk to the person, connect emotionally with them. And that's what we do. I think when we do it well, we're doing it our best.
Well, you mentioned that global perspective, and I do want to bring that back to the conversation around Gen Z, since, that's a nut that many are trying to crack. You think about Gen Z, and it seems like looking at their shopping trends, that it's much more about items. They're more comfortable, buying luxury, buying affordable luxury, whereas millennials, which is my generation, it was much more, and it still is about experiences, travel, for example, it comes at a premium. But the American Gen Z shopper, does that profile apply around the world as well?
So it's interesting, something we've learned about Gen Z. First, they're the most connected generation in history. The influences somebody sees in Seoul, in Shanghai or New York are similar. If you think about some of the number one music or movies, they're similar across all geographies. And because we're all so connected socially, their likes and dislikes are often very similar. Now, many Gen Z will tell you they love experiences just as much as you love experiences. The difference, I think, is they're very, very thoughtful about their purchases. And sometimes people talk to me a lot about, wow, people are shopping in the real world again, and they're going to malls again. Malls are alive and thriving. Mm-hmm. Why is that? And one of the reasons, I think, because maybe during some very formidable years, Gen Z, because of COVID, we're shut in. So they're very much engaging in real life experiences and community experiences. Shopping is a social event. Today, you'll come into a Coach store, you'll see Gen Z shop, they'll be with their friends, or they'll quickly be on their phone showing their friends the bag they want. Mostly they've already come in with a great understanding of what it is they want.
Have you ran into any issues as of late with regard to being able to source your leather, whether it's because of tariffs or the cattle shortage we hear about, or even just the idea that, you know, the expertise in being able to tan leather is the number of people who can do that these days is a lot different than what it was when you guys were founded in 1941.
Yeah. So fortunately, we're a substantial house, and we have deep resources. We started as a manufacturer, so we still have a manufacturer mindset. We have leather experts in our company. We source leather from around the world. We work with the best tanneries. Our units are significant, so people want to work with us. So we do get the choice to get what's the best out there. We have not seen an issue with our leather suppliers, nor have we seen an issue with our make manufacturers. We are making Coach product with some of the same people we've made for 20 or 30 years. We have very deep relations. Of course, tariffs is an issue, but one thing about our company that you need to bear in mind, we see in the next 3 years 70% of our growth coming from international. So when I'm selling internationally, tariffs are no longer in play.
And our thanks, of course, to Todd Kahn. He is the CEO and brand president of Coach. A really interesting conversation on how you revitalize a brand and keep that momentum going. And we want to stick with retail now because U.S. same-store sales climbed 7.2% last week. That's up from last year prior. That is according to data out of Redbook today, with early indicators pointing to a solid February gain. Investors also bracing for Walmart earnings expected before the bell tomorrow. Let's discuss all that and more with Naveen Jaggi, President of Retail Advisory Services over at JLL. Great to have you back with us, Naveen. And I want to go to this line in your notes. I think it really helps describe what we're seeing in the consumer landscape right now, that you have this barbell consumer. That's the expectation for you in 2026. You have, of course, value orientation, and then you have sort of the premium experience as well. In your view, where does that leave the middle market?
That's a great question, Katie, and thanks for the invitation to be here. I think that the middle market's going to be squeezed, and I don't see necessarily an end to that game because we've seen many retailers either pivot to the lower value side or notch up to more of a premium value. I mean, seeing brands like Kmart and Sears and legacy brands like JCPenney, they have dwindled in fate over the last few years, and there's no way to necessarily bring them back. So I think the average consumer in America today knows how to purchase, which is for daily goods, go to Walmart, go to your daily goods value opportunity. And then on the weekends or once a month, you want to spend money, you'll go up to a Nordstrom's, you'll go to a luxury brand or a premium brand. And that middle market will likely fade over time because even the people that make over $150,000 a year will still shop at a dollar store or a Walmart or value retail store. TJX has proven that you can go on a journey to find something, and people that make over $150,000 a year will shop there. So I think looking at our economy today as barbell more indicates the fact that consumers are smarter about the way they shop and not necessarily looking for just the middle price. They're looking for the best value, the best experience, not just the best price.
And it's interesting, you know, to hear that expectation of yours that you would expect the middle market to fade over time, that this isn't just a 2026 story. And I'm curious, in your view, how does that reshape sort of the physical footprint of the retail real estate market going forward from here?
Well, I think if you look at the way the retail landscape has changed over the last 15, 16 years, really 2010, coming out of the great financial crisis, showed that you had to evolve. We had our moment in the sector back in 2010, 2011. And so in even shopping malls, for example, they are bringing in value retailers in certain parts of the malls. That's one way to shape the physical space. We're also seeing that Walmart, which I think still is one of the best retailers, if not the best retailer in America, is showing that their stores have evolved. They're making their stores not just about stacking a lot of items in the aisles. They're making them clean. They're making them fun. They're making the place to go to Walmart actually real value. I think Walmart's done one other really great thing in terms of shaping the way we think about consuming, which is that expecting to get products online and delivered to your home used to be the realm of Amazon. I think Walmart's caught that game up and made it even better. So if I'm thinking about the way our retailers are shaping how consumers think, it's not just about the brick and mortar space we're shaping, it's the way they think about consuming. And in the eyes of the consumer today, we're looking not just for great value, but for a better shopping experience. I think many retailers are catching that, including Coach.
Well, yeah, and let's go there, Naveen, because I mean, Todd Kahn did talk about that in the interview, this idea that they've actually seen their mall-based stores actually do pretty well. And in fact, he said overall, he's seen a lot of return to malls, not just for Coach stores, but the idea that you have a generation that is looking for not so much experience, but the idea of interaction with the brand in a way that necessarily you can't always get online. Is that an investable proposition for you?
100%. I'm a big believer in the malls remain. I've always said that the very best malls are not just shopping destinations, but they're experiential destinations. In other words, we go there with our family. We spend 3-4 hours there. We'll see a movie. We'll eat. We'll shop. And I think that Coach and many other brands realize that malls are here to stay. They're a great part of the economy. Now, look, at the end of the day, it's about execution. So great performers like Simon, for example, do a great job of making their malls look very attractive. So I think brands like Levi's, which I've seen, Sephora, Ulta, Coach, we just mentioned a second ago, not to mention the premium brands like Tiffany's and others, they've done a good job of bundling them together in a place where consumers can go from one store to the other and get the same experience. I don't see that changing. And quite candidly, in the next 10 years, I see the best malls in America getting better. That's why the occupancy of those malls are north of 97%, because retailers want to be there. That's insurance against changes in consumer tide and the way they think about consumption.
Yeah.
You can go to a mall and get all experiences in one time.
I'm curious if you can draw a distinction between what you're seeing in the mall space, and I know that's a big part of your focus, and what you just see in the normal kind of streetscape. I mean, certainly here in New York, you have a lot of vacancies. Some of that's just a product of bad pricing on the part of the landlords. But the idea of just having a strip of stores along, a several block stretch, unless it's Fifth Avenue or Madison Avenue, you're not necessarily doing too well. And it's not just a phenomenon here in New York. You see that in other major cities like Chicago, like LA, even in Dallas.
Yeah, so I'm in a suburban-oriented city in Houston, and certainly there's parts of Houston where there's quite a bit of vacancy and bad product. But I think that tells you that retailers and the demographics of the consumers, as they shift, the better developers, the better owners have converted those assets into something that the consumer wants with better tenants. There is a limit to space, and as we talked about this, Romaine, we're in a historical low on new development. So either the investor invests in upgrading their asset or they will decline over time. So to me, I think it really boils down to, do you have quality investment that can bring in the quality tenant to make that asset look attractive? Otherwise, it'll just be another strip center, another town in America. And the last thing we want to see is a 10,000 square foot beat up shopping center with a vape and a tattoo shop. We don't need those.
Don't tell us about it. We won't even talk about all the, let's just say, weed shops all over the New York City. Naveen, always a pleasure talking to you. Really great insights as always. Naveen Jaggi is president of Retail Advisory Services at JLL.
All right, let's take a look at some of the notable after-hours movers. Of course, we've got a lot of earnings after the bell, and boy, look at that reaction, a sea of red, especially when it comes to Avis, down about 13.6%. Their full-year adjusted EBITDA outlook fell short of expectation. Molson Coors, we know that, when it comes to some of these alcohol brewers, it has been a tough time. No exception for Molson Coors, down almost 8%. Meanwhile, Cheesecake Factory also down about 5% or so, and Carvana closing us out, shares down about 22%. Fourth quarter adjusted EBITDA missed estimates. This is The Close on Bloomberg. Tech investing giant Battery Ventures, known for backing companies including Coinbase, Affirm, and Databricks, raising $3.25 billion to fund new tech deals, including in the software space, where it has a long history of involvement. Joining us now, I'm pleased to say, is Neeraj Agrawal, general partner over at Battery Ventures. Neeraj, it's great to talk to you on the heels of this fundraise. Let's talk a little bit, though, about the software space, because we have to put this conversation in context with what we've seen in public software companies. A lot of existential worries right now that AI is going to, again, pose a risk that could put them out of business or, have them be obsolete in the coming years ahead. With that in mind, what are you seeing when it comes to the private software space, where, of course, you do have this very long track record?
Yeah, Katie, first of all, thanks for having me. We're very excited with the new fund to invest in this innovation wave that's coming. Maybe just answer your question on the public side. I think it's quite overblown in terms of AI killing software. I actually think there's three things that are happening that are all it's kind of happening simultaneously. It's far more of a nuanced market. First thing is the SaaS market is maturing. And so as a result, you've got growth rates coming down, and over the last few years, you've seen multiples come down. But the second thing is AI is really going to expand the pie. We've seen this in the transition from on-premise to cloud, and now cloud to AI. In every one of these transitions, the market grows quite a bit. And I think the same thing is about to happen here. But the third point is the market doesn't know who's going to capture this expanded pie. Is it going to be the incumbents? Is it going to be the AI startups? Or is it going to be the labs? And whenever there's uncertainty, the market tends to pause. And I think that's what we're seeing here in the public markets.
Well, talk about the private markets then, Neeraj, because I am curious as to how you potentially suss out who actually ends up being the beneficiary. I mean, not everyone's going to win here, and I know the general strategy here is to kind of spread yourself out a little bit to account for that. But this is a lot of money, and I am curious as to where you plan to put it.
So we're seeing a ton of innovation in the private markets. The way we think about it is there's lots of different themes that we're chasing. There's some horizontal themes and there's vertical themes within the application of AI. You've got horizontal areas like customer service, software development lifecycle, procurement. We've made an investment there. Then you've got the vertical use cases, and these vertical use cases are very similar to vertical SaaS, and we think those are going to be very much enduring businesses. For example, we invested in a company called Liberate. They power call center customer service work for insurance companies. So now when you get into fender bender, instead of calling the call center and talking to a human for 30 minutes, you talk to their AI. And the AI answers all your questions. It helps you figure out how to get a rental car. And the amazing thing is, Ramin, people like talking to the AI agent more than they like talking to the person. Maybe because they're not being judged. I'm not sure why. But you're seeing this happen, and there's a lot of cost savings that are coming as a result of these AI use cases. What we look for in every one of these new companies is this question of, is the startup going to win, or the incumbent, or the research lab? And we have to make that call. In some cases, we think, hey, the incumbent is going to win, meaning the large legacy SaaS company. And sometimes we think it's a startup.
Well, I am curious if you can just kind of draw a distinction, too, between some of the areas that you're talking about specifically, and kind of at least what the public is familiar with now with these large language models and chatbots, an investment area that my understanding Battery is a little bit less interested in as a pure play. Can you draw that distinction for us?
I'm sorry, say that one more time. Maybe I missed the question there.
Are you investing at all in any of the large language model companies?
So we're not a direct investor in a couple of the large ones. We are investors in Databricks, and we're investors in the next wave of foundational lab companies. And we do pattern match off the internet. When I've been in Battery now 25 years, and if you look at the value creation, a lot of that value creation actually happened in the second wave. Google being a second wave company, Facebook, Twitter. And we think the same thing is going to happen here. We think of this as a decade-long trend that we can invest behind, some value being captured in the first wave, but a lot of it will be captured in second and even third wave companies. And as a result, we're not investing with this high degree of FOMO. There's a lot of FOMO in the venture market where people are chasing investments regardless of valuation. Every time that has happened, when you go 3-4 years past that point, you look back and say, oh, we invested at too high prices. We've been much more disciplined and kind of thoughtful about where we want to allocate capital and not try and get caught up in the hype.
Let's talk about the other end of investments, and that's exits. What's your expectation for exits this year, and whether or not, what we've seen in the past couple of weeks when it comes to these public software companies selling off, whether that affects that outlook at all?
Yeah, Katie, it's a great question. I do think we're going to see a much more challenged environment for public exits right now, except for the 3 or 4 very large companies on the private side. And the reality is right now the entire public market is on sale. So it's very hard to convince a portfolio manager they should invest in your company, especially if you're not willing to go out at a significant discount. So my expectation is, except for a handful of major names, we're not going to see a ton of IPOs, maybe until the second half, most likely in calendar year 27. The strategics, though, are very active. They are trying to accelerate their AI roadmaps, and they're looking at the startup community and trying to get talent and learning this new way to work. Because the reality is you can't just put AI lipstick on the pig. You need to reinvent how you build software, how you price software, how you sell software. And these AI startups allow these strategics to get that capability.
All right, Neeraj, we have to get you back to talk a little bit more about this. We're up against the clock. Neeraj Agrawal, general partner over at Battery Ventures, fresh off a $3.25 billion funding round. We'll set you up for what to watch when we come back after the break. This is Bloomberg. All right, let's get you set up for what the markets are going to have their eyes on over the next 24 hours. We start off in the morning with a couple of key earnings.
Oh, big time. We're going to take a look at earnings from Walmart, a very important read on the economy. We also get earnings from Deere as well. We're going to check in on what's going on when it comes to agriculture. Also, some other earnings as well.
Yeah, and we're going to get Live Nation as well. We just had a headline on that, Newmont, Akamai, Etsy. So a few names that were actually in the news earlier today going to be reporting tomorrow on Thursday. We'll have full coverage for you on that. We're also going to have full coverage starting at 12:30 p.m. Eastern Time with the co-CEO of Netflix, Ted Sarandos. What do you want to hear from him?
Yeah, I mean, there's a lot I would want to hear from him as it relates to what's going on with Warner Brothers Discovery. Netflix apparently still the favored bidder, but they are talking to Paramount. So I wonder how he feels about that.
Yeah, I'm curious to see what his strategy is and maybe how he kind of feels about some of the political dynamics going on. We are going to get some more economic data as well. Jobless claims, trade balance. You like trade balances?
Yeah, why not?
Okay, and pending home sales as well, which may give us a little bit of a read. And a lot of Fed speak as well, which I know you love.
Speak. I do. I want to hear exactly what they're thinking. Bostic, Bowman, Kashkari, and Goolsby sort of bring us home.
All right, well, full coverage of that right here on The Close. For all your market-moving news, for your political news, stick around. Balance of Power comes up at the top of the hour.